All right. Good morning, everybody. The Asian markets are closed for a holiday, so the volume is a little light. Doesn't mess with things too much, but at least that explains why the volume is light, right? If we come in on any given morning and we find the volume light, we need to know why, because they could be sitting out waiting for something we don't know, or they could just be closed for holiday. So that's what it was this morning. No big deal. I've already shared the founder's note for this morning. It's a good read, talks about the call wall and the upcoming options expiration. Certainly provides a little bit of perspective, no matter if you're a day trader or a swing trader. So just like in our markets, we can be closed and still have the futures moving around. Hong Kong is flat. Europe is going to be one of the biggest threats to our market today. They've got some European Fed speakers highlighted that can really shake things up, but they're not the only ones. US is going to have Fed speakers talking today as well. Small caps up the most, near 0.5%. Everything else is closer to zero or below zero. Tomorrow's kind of a big deal with CPI. Remember, we had revisions last week, and now we're getting CPI this week. Going to have a lot more Fed speakers, kind of continuing on in that theme that Powell started, and they've all been pretty much, backing him up, trying to stand out for themselves and show that they are their own person, but really they're just reiterating what he said. Jobs are going to get more important as we get closer to the end of the week. Remember, that's one of the gauges that the Fed uses for trying to find this mythical neutral rate and how far past the line they've stepped. They'll know if they're putting the screws to the system too hard, because they'll start seeing, waves of unemployment. So we can see at 1 o'clock today, Bank of England, Bailey is going to be speaking. But earlier in the day, we've got Lane and other European central bankers, and then also US Fed speak. So it's a full house, mostly just sentiment driven, right? Trying to win the hearts and minds, change the warm, fuzzy feeling. But the semiconductor rally hasn't ended. And if that doesn't end, then the rest of the market isn't going to end. It's all tied to that right now. Other than those Fed speakers, 11:30 and 2 o'clock today is the time frames worth keeping your eye on. All right, it's worth starting the week taking a look at where we're at on a weekly chart. So we had a nice expansion last week, but unlike the week before, we closed in the upper portion rather than having faded back a bit before closing. It might not seem like a very big distinction, but when we fade back like this, it sets us up for, the new week where we can come down and hit that 50% mark, get a nice rally, and then use each one of these levels as targets and then as goals. So when we get there, we're able to focus on the next one. It's a really nice setup. When we close near the highs, there's not a lot of pivots there to work with. and the midpoint or the halfback is a long ways off. So it's not to say that we can't do it, just that to get that kind of a reset, we're going to need a lot more weakness. We didn't really gap up. I mean, we can zoom in and find just a micro gap in there somewhere, but it's already been covered. Take last week's range, map it out. 50.24 is the halfback. 50.60 is my warning center. Measured move is 5,100. So it just 50% of last week projected to the upside. There is something called a 5-bar rule. And if you hold to that, then we've had our 5 bars. It's not exactly, been working out too well if you count back how many times we've exceeded the 5 bar since QRA way back in November. And remember, we got QRA and we were expecting things to drop and to pull back. And we've seen that rising dollar. We've seen that rising 10-year. But with this semiconductor freight train and AI drive to the upside, there's just nothing stopping this thing yet. So the consensus seems to be that we're going to just continue to grind ever higher until, I don't know, till the bubble pops, right? Some have said that would be NVIDIA's earnings coming up on the 21st, I think. But we continued to see a lot of other semiconductor companies that had earnings and maybe did or didn't do too hot, but that didn't slow things down. Yes, the 21st for NVIDIA's earnings. And what if the earnings are positive, right? That it's just gonna, keep on going? At some point, every bubble breaks, but when's this bubble gonna pop? So we've got our 50% weekly measure projected to the upside, 5,100. It's exactly right, the tulip bubble. Yeah. It's so hard to fathom the idea of trading back in the 1600s, right? I mean, I struggled just thinking about how they did it in the 1970s, drawing their own charts, waiting on the mailman to get your charts from the broker in the mail. Oh, no, thank you. So Friday's candle closed a lot like the week's candle, but we have a little bit more of a pullback to that 786 area. So it's a nice setup if we're looking for a continuation like a trend, just your basic run-of-the-mill trend. Then we're going to get that 786 pullback before a continuation, which is where we're at right now. All right, breakout, run up, pull back, breakout, run up, pull back. If that's what we're going to get, then we need to hold this 786, that 5040 or 5041. Doesn't mean that we can't go below it. We can wick down there, but by the end of the day, we need to close above that red line, that 5040. If we do continue to fade, we do have the halfback 5030. I'll mention the cog line 5031 or 5032. It's not set in stone. That cog line would be the 50% mark. We definitely need to hold above that. If we break that, then we've got a halfback break. We could put in the 25% mark, and we would focus on hitting that. Otherwise, we're looking for a continuation on this move. That would get up back through 100. We'd have to get through the warning center at 50.50 and then get up into that 50.66. Then we could focus on the weekly target, which is 51. So level after level, we just focus on them and take them right on up. The volume is light this morning, but we already know why. The Asian markets were closed for holiday. So it's not necessarily because of economic data points. They're not sitting out in fear, waiting on something. It's just a lack of participants. Make no mistake about it, lower volume is when price can really move. It can make some wild accusations, and that's because there's just a lack of participants. So far, we haven't done that, but if you look at the cumulative volume, the CD, we're very divergent this morning. So price is sideways, kind of slightly grinding higher in the barest sense of the word, but the cumulative delta volume on the ES, this is what we're looking at, the ES, is definitely positive. So it started picking up around midnight, and it's just been grinding up. This chart in the upper right portion is a 5-minute chart. So you can really see that pickup. We may be grinding sideways, but there's a lot of buying at this level. Keep in mind, there's a couple of ways to view this. There's always the perspective that they'll get frustrated with the lack of follow through. So imagine it from your own point of view. If you continue to buy and buy and buy and price continues to not move, what are you going to do? Probably swap your position or just get out, right? But on the other hand, two-sided market, when we're residing around the VWAP like this and there's major transactions going on, then one side could be getting out and another side could be happily taking their liquidity. And so they're just passing it back and forth like two drunks in a can of beer. Bad analogy, huh? Two cats in a bowl of milk. I would continue to watch this for reciprocation, but for one side to be done. We'll know that because it'll really start to expand. Very likely testing last week's high or even just Friday's high. They're both the same thing. And or dropping to the downside to test this daily pivot point, which we have not yet hit this morning. We do have new voodoo levels. These are from February 5, so they're really fresh, really new. That's a voodoo line right underneath this, 5039, but my focus is more on the daily pivot point. We haven't hit it yet. It won't count as an MDP until tomorrow, but we have an MDP from yesterday, even though we got pretty close to hitting it. Close doesn't count. We are a long ways away from the ADR half in either direction because we haven't really gone anywhere. We're flat on the day, down one tick. So we are exactly where we started last night, having done nothing. That can be a bit of a warning by itself, but as much as it is easy to contemplate shorting a market that's sitting at this level, or believing that the market has to go down now after having run so far, I'm begging you to pause in that belief and just realize that we could continue even higher from here. Now, there's a phrase in the trading world about what's more likely. After already having moved so far and gotten to this point, what's more likely, that we fall here or rise here? What's much more likely that we fall here, that we digest, retest the 10, give price time to heal itself after such an exaggerated move. That's the more likely outcome. But you don't want to assume you're going to get that. You want to look for signals and signs that says we are beginning to get that. Then you can play it. Till we have that, this is still on the move. $10-day, 30-minute volume profile, and look at that. The point of control is at Friday's levels. Cog line 50.11, and the point of control is at 50.13. We don't really have a classic shape here. We do have some air pockets below the point of control, which could drop us down below 5,000 relatively easy, back into that 49.75 area. But we would have to get to 5,000 first, and that's really where the trouble starts. Just getting to that 5,000, we'd have to get through that point of control. It is worth noting that the area we are residing in here, above that 50-40, it already has a lot of volume. We were just talking about the low volume because the Asian markets are closed, the sideways price action, and the continuous transactions around VWAP. We're definitely hitting a ceiling here when it comes to liquidity. We had the same thing happening back here, and it got a little bit of a reset. I don't yet have a name for this pattern, but we see it enough. It's almost like in my mind, it's one of those kids' toys, the spinner, you know, so old toy, not the new fidget spinners. It looks kind of like a Hershey's Kiss upside down. Spin it on the table and it spins and spins. That's what I think of with this pattern. But you start at the midpoint, you get your reciprocation one way, and you get the same reciprocation in the other direction, and then it just comes back to balance again. Seen it before, we'll see it again. I just don't know, I don't have a name for it yet. Probably should just call it a fidget spinner. But this little setup back here is the same little setup that we've got going on right now. Really tight range, and they're just trading around that VWAP. We want to watch for that liquidity to dry up on one side. No point of control from Friday to carry forward since we opened it right there, and we've been holding it all night. Nothing to tell between TPO and volume profile this morning. They're so close together. And it really just exaggerates or highlights that range. This is a very tight range. Remember, markets are like nature. They don't like compression. If you don't release the energy, then it's going to explode. It's one of the reasons that we like a really tight range, because it builds up pressure and then it breaks out. So we are definitely building up pressure. If you were to put on the RSI Laguerre and perhaps measure it on a different time frame, I'm sure we've got a lot of energy stored up. The RSI Laguerre is about the only indicator I've ever come across that talks about energy rather than, you know, strength of trend, inertia, momentum. The analogy I always use is for price to move, is it moving with energy behind it, or is it moving to build energy up? So if you are throwing a ball in the yard with your kids, you throw the ball, you're giving it energy. The energy dissipates as the ball moves. Take a ball to the top of a building and drop it. As it falls, it picks up energy. Price is exactly the same way. If you are using the RSI Laguerre, you can gauge that move behind price. Is price moving to gain energy? Or is price moving and burning energy in the move? In this situation, when we're all bundled up, we'd be able to gauge, is it even building up energy here, or how much is it building? We broke out of the weekly expected move again and closed out of it last week. So that's 2 closes in a row outside the box. That's not good. We're supposed to close in the box 8 out of 10 times. So the fact that we've closed out of the box even just 2 times, let alone back to back, is a warning. That's what this tool is telling us right now, that the volatility that is being used to draw our box is not catching the real move in price. If it was, we would see smaller moves in price, or we would see a bigger box. Rather than counting every single week and trying to figure out what our current hit rate is, I usually just count back 10 weeks. I'm a little lazy like that. 10 is a round number, so it makes it easy to run percentages, and it's 10 weeks instead of 52 weeks. So if you count back 10 weeks, how many Fridays did we close outside the box in the last 10 weeks? I'm not going to sit here and count this morning, but I can see 3. Here's 1, and the last 2. So we're not even hitting our 80% in the S&P. Now, it's a 1 standard deviation, so we're only supposed to hold 70% of the time. Statistically, if it was Apple or Microsoft or anything other than the S&P, 70% would be fine. And we're there. We're at that 70%. But the S&P is more accurate than that. And it usually covers an 80%. So what this is telling you is that you don't want to run iron condors on a week-to-week basis, right? Those Friday expiration iron condors, because we're likely to exceed the expected move and cause your iron condor to fail. So you don't want to play ranges, you want to play expansions, at least until price and volatility agree with each other again. The other thing we want to look at the start of the week is the size of the box we have this week in relation to the size of the box we had last week. Now you can nerd out all you want and get this down to the tick, but I don't typically stress on it. Look, it's close enough. We're trying to get a feel for what's the volatility like this week compared to last week. So if we take last week's box and we set it on this week's box, we can look at it and say, is it smaller or bigger? It's smaller. So the volatility is less this week than it was last week. And that makes sense, because when price goes up, volatility tends to go down. At some point, however, if we run too far away from that 10, the market will start to price in a crash to the upside. They'll start to get scared of that blow off top, and we'll see volatility rise even as price rises. And kind of keep your eye on skew for tail risk. So we're not even 1 1/4 above the 10-day. That's not overbought in the short term. We haven't moved too far, too fast, and we could easily continue to expand another 2%, and we still wouldn't be overbought. We'd be starting to touch that area of overbought at that point, but we're not there yet. And look how we're right in line with where we've been, say, since most of January, was holding right here at this 1% zone. It's just a good, steady 1% average away from the 10-day, excuse me. So we're not overbought. We're not overextended. It doesn't owe us a pullback. And on the weekly perspective, we're at 3.5% above the 10-week. Now that's a little overextended. That's a bit much, but we've already started to pull back, because last week we got above 4%. We were above 4 1/4. That is an area we have rarely been to. 3 times we can see on the screen over the last 18 months where we were higher than that level. And it didn't hold for long periods, but this is a weekly time frame that we're looking at, or a weekly measure. And we're on the decline, meaning we're healing ourselves and moving back towards that 10-week. So if we just stay where we're at, the 10 will come to us. We don't have to go down to the 10, in which case that would be correction through time rather than correction through price. And it will accomplish the same thing. We never had to pull back, and we're able to continue that upside drive. This says we're a little extended, but that extension could last through the whole week. It's worth taking a look at what's going on in the sectors. The top 3 are the sectors we expect to do good in a strong economy and in a good risk-on environment. The bottom 3 are what we expect to do good in a bearish economy or a risk-off environment. And the 3 in the middle are kind of midline. They would expect to do good in both a strong economy or a poor economy, a strong market or a poor market. If we look at the bottom, staples in the lower left and utilities in the lower right are down the most, especially utilities, almost down 2%. And that dotted line is LINREG, and it's like the mean and the trend just by its slope, by the direction that it's pointing, and the mean just by being where it is. We would expect price to cross back and forth. Think about the waves in the ocean. Well, 0 is a flat, calm ocean, and then you have waves and troughs below 0, above 0. So the dotted line would be 0, and then above and below, and it's just like a wave back and forth. But it's sloping down. It's not healing. It's not getting better yet. 50's under the 200, prices underneath both. Look at staples, on the other hand. It's sloped upwards. 50's trying to get back above the 200, and price is already back above the 200. It needs to keep this if it's going to turn things around. And energy is just a sideways mess. The LINREG is barely pointing to the upside. 50 and the 200 moving average are tangled up with price. Everything's just sideways, really tight together. That is a very strong range that at some point is going to break. It's just building up more and more energy. There was a comment about presidential elections and energy not really having the freedom to get higher during an election cycle, which makes sense, right? Every sitting president wants to be able to say they've lowered prices and they're doing what they can to help. And one of the things that they can do is they can mess with the gas pump prices, right? Because they got the strategic petroleum release that they can flood the market with enough gas that the price of gas stays muted. But they can only do that for so long. But if there's some kind of collar on energy, that would explain why we're really not seeing much of a move here. The call wall is above 5,100, so we got that out of our way. The volatility trigger 40 is below 5,000, let's just say it that way. and the put wall is at 4,500. It's a long ways down. Now, I'm a little two-sided on this. If I'm a market maker and I'm ready to run this to the downside, I don't want that put wall too close because it's going to get in the way of me monetizing my puts. I don't want to run them a short distance. I want to run them a long distance. So I would roll that put wall out of the way, roll it down. So I kind of see that move down in the put wall as a bearish behavior. But that's not enough by itself because they did roll the call wall up, and that is bullish behavior. So maybe they kind of cancel each other out. One thing it does show, though, is that nobody has an answer to, are we going to continue to go even higher now? With them rolling the put wall down and the call wall up, it shows even the market makers are just preparing for a move in either direction. They're not calling a direction. They're just ready for one. If it goes up, they'll make money, and if it goes down, they'll make money. That sounds like the right side to be on. Most places will calculate it from open interest. Some of them will calculate it by the highest amount of premium, right? That way, if it's a call wall, say an out of the money call wall, way out of the money, but the premium being, since they're so far out of the money, would be so small. If there was a higher premium, even though it's lower volume or lower open interest, then it would be in a different spot. So it always depends on where the tool came from. That one happens to be Spot Gamma, and they've got really great videos free on YouTube that explains their tools. They did that because they want you to buy their tools, and they kind of assume you won't buy their tools if you don't know what their tools are doing. So they don't put it locked behind a firewall. They want you to learn what it is, and that's where you can go and check it out. I tend to use Spot Gamma for these call walls because the ES, right? If we were going to look at the S&P through SPY or the SPX, we could look at, oh man, there's a million different places that'll do that. But when it comes to the S&P, Spot Gamma is the only one that, not the only one, it's the one that I use. And it's hard to find a company that'll do it on the ES or do it on the futures at all. Generically speaking, though, yeah, it's the open interest. Don't assume that, though, I guess is kind of my point. Always know who the creator of the tool is so that you know if it's using premium or not. We got nothing. I'm sitting here flipping through it thinking maybe it'll adjust. It'll change its mind when I flip through it, but it doesn't change its mind. It's the same junk. We do have the semiconductor XXX bull, which to me is just, it's like looking out the window to see if it's raining or not. It's not really going to help all that much. And it doesn't change our mind about anything. So we got Bitcoin, solar, semiconductor, XXX, and I mean, really, that's it. Usually we can find pot stocks also up. But when it comes to pot stocks, Thinkorswim doesn't usually catch them that well in the pre-market. My volume measurement settings are just too low. But TrendSpider does a really good job with pre-market stuff. So just come over here, check the sectors. Things that are down, nothing hits that 0.5%. And things that are up, what's that? Pot stocks. Imagine that. Doesn't look like my normal setup. There we go. That's the missing piece. So a little bit of gap up this morning. We're still inside yesterday's range, though, since they closed near the low of the day on Friday. This gap up just gets us near the high of the day from Friday. Still need some kind of follow through, but pot stocks are up this morning. You don't want a market rally in the S&P and the NASDAQ led by Bitcoin and pot stocks. You know what I'm saying? That's not enough. That's like climbing the mountain using floss. Don't want to take that route. We have precious metals up with silver breaking outside of yesterday's range. Looks like it's breaking out of last week's range. Yep. So that's a good start. It was kind of due. US dollar Japan fading back. We should see a fading 10-year and a fading dollar, or the dollar index. We're not really seeing a fade in the dollar index, though. It's still holding near the, well, let's say holding above that 50% mark from Friday. If we were to look at Friday from high to low, I missed that high, but it'll be all right. That's close, but close counts in this case. We're still holding that 50% mark in the Dixie. US dollar Japan starting to at least attempt to turn around here. So we got bonds trying to climb, the dollar trying to climb, the S&P and the NASDAQ with that bullish divergence in the cumulative delta. We could try some swag levels. Yesterday's low is a really good line in the sand. We want to see the 10-year get below yesterday's low, or Friday's low, if you want to say it that way, as a good starting point for a move to the downside. The dollar, on the other hand, you know, even having this discussion about the 10-year and the dollar feels like maybe a little bit of the hamster on a wheel, because they haven't been that helpful. We've been seeing them, move with the S&P and the NASDAQ instead of opposite of. But at some point, this correlation is going to break. So if that's what we're looking for, let's get the dollar below the 10-day moving average and get the 10-year at least down to the 10-year moving average. It is good to see that the US dollar Japan is pulling back a little bit. The intervention threat there is still pretty high, even at these levels. So this is the NY Fang, or the Mag 7. Pre-market, we're gapped up just a tiny bit, but we are holding inside of Friday's range. This range that we're holding in, if we take it out into, the forever time frame, we've never been this bullish or this high before. Now this is the homemade version of the Mag 7. But this is the real NY FANG ETF or ETN, and you can see it looks exactly the same. So if you don't have charting software that allows you to put in all these weighted figures, and look, you're not missing anything. I promise. It might make us feel snazzy and smart to have this weighted chart, but if you don't have it, you ain't missing anything. Just look at the NASDAQ. It'll look just like this chart, or the NY FANG. There's a new one called MAGS, M-A-G-S. I thought it was M-A. Helps if my typing gets better. Round Hill Magnificent 7 ETF. You can look at that, which is gapped up completely outside of Friday's range. Or you can look at FNG and then add up or down. So here's the FNG. That's the New York FANG Index Futures, and it's tradable. But they also have just the XXX up and down. You can also make a ratio out of that, put them both together, the up versus the down. And I mean, look at that. It's straight up. 10-2 yield curve, still below zero. There's been analyst talk about getting back down to -6. That would be bearish. But continue to not do that. So I don't know. And IWF versus IWD, this is growth versus value. And it's also still very bullish. When this is pointed up, we're talking about tech doing better than staples. When it's pointed down, staples doing better than tech. Think of it that way. Bullish versus bearish. Think of the 2022 bear market in the S&P. Well, look what this did during 2022. Right? So when this is going down, the S&P and the NASDAQ are going down. It's bearish. And when it's going up, the S&P and the NASDAQ are bullish. Well, this thing ain't done yet. This is definitely overextended. So is the NY FANG, the MAGS, the FNGU, whichever, any of those that you want to look at. The cumulative volume index for the NASDAQ versus the NASDAQ composite, right? So the white line is the CVI, cumulative volume index. No divergence in there right now. They're both pointing sharply higher. So the takeaway is that we don't have anything. We're not even developing a topping pattern here. But we are going to want to see more sectors than precious metals, pot stocks, and Bitcoin. We need more than that. So that's what I would be looking for today. Keep your eye on the FANGs, either individually or as a group. Keep your eye on tech. I guess you could just use the XLK. I tend to use just the NY FANG, but you want to see that those 7 at least get into the game for a continuation to the upside. We could rally without them if they're not falling, but we can't rally without them if they are falling. And even just rallying without them if they don't fall, it's going to be a choppy, difficult rally. We kind of need them to participate for a good upside move. So we got energy now below the 50% mark. That's kind of my line in the sand. Energy by itself generally wouldn't be enough to send us to the downside, especially knowing that that collar is on there too. And if it was going to affect our market, going up would affect us more than going down, right? Because if energy costs go up, then that kind of leans into the narrative of inflation and rising costs and blah, blah, blah. And that could affect our market, but it's not going up, it's going down. That's more of a bullish bent, right? A tailwind rather than a headwind. It just adds to the idea that this market isn't done running yet. Everybody, be careful, be safe, have a good day. I'll see y'all tomorrow.